Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 329 on June the 28th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on the ProShares Ultra Bloomberg Natural Gas ETF, Carnival Cruise Lines, and the VanEck Vectors Gold Miners ETF, and we discussed three new trades on Beyond Meat Inc., AT&T, and Snap Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets finished the week slightly lower, pretty much unchanged. The Dow Jones Industrial Average lost 31 points, closing at 39,118 points. The S&P 500 index lost 4 points, ending the week at 5,460 points. Now it's time for the topic of the week. The topic of the week is overtrading. I haven't discussed this topic in quite a while, but it's still a major concern. Overtrading simply means getting in and out of the market too often. Let's do some simple math. Let's say that every time you make a trade, it's a 50-50 win or loss. That means with one trade, you have a 50% chance of winning and a 50% chance of losing. With two trades, you have a 25% chance of winning. With three trades, you have a 12.5% chance of winning. And with four trades, that percentage drops down to 6.25% chance of winning. This math assumes that every time you make a trade, there's a 50% chance of winning. I don't think this is exactly correct, even though mathematically it is. You're supposed to multiply probabilities to calculate the overall probability. Now, I've experienced days where each win led to another win, meaning that a winning trade increased the likelihood that my next trade would also be a win. It's like you're in the zone. Regardless, the more often that you go into the market, the higher the likelihood that you're going to lose. I try to keep this in mind so that I don't overtrade my account. I would rather make one right trade a day than four trades hoping that I eventually get right. I've even had days where I was successful in the morning and then made losing trades in the afternoon. Those are the worst because you know that if you could have taken the rest of the day off, you would have been up money and you would have had more fun probably. This doesn't just occur in option trading. It can occur in stock trading, futures trading, bond trading, crypto trading, forex trading, and any other type of trading. Keep that in mind as you plan your day and plan your trades. I have even had days where I'll limit myself to 2 or 3 trades overall. That's it, hard stop after that. And I typically make more money on those days just because I gave myself so many fewer trades that I could do. The specifics of what you decide to do might be a lot different. The main thing I want to point out is that it's worth keeping an eye on over trading. If you look back and you have a losing day and you notice that your losing days are days when you made like 5 or 6 trades and your winners are when you made 1 or 2 trades, let me cut to the chase. Look at the data and go with the 1 or 2 trades. And by that same token, if having 6 trades ends up leading you to your best trading day ever, keep trading. Overtrading is relative, right? It's relative for each of us. So overtrading, 4 trades a day might be fine for me, but that might be too much for you. Or 8 trades a day might be fine for you, but for me, if I make 8 trades, it's almost guaranteed that I lost money that day. So it's important to track your own results to see what overtrading might look like for you. All right, so that's it for the topic of the week. Let's go ahead and get into the trading review of last week's trades. We're going to start off with the cover call on the ProShares Ultra Bloomberg Natural Gas ETF. Symbol B as in Bravo, O as in Oscar, I as in India, L as in Lima. At the time, the stock was trading for $18.35 per share. I looked at buying stock and selling the July 19 call at $1.82, hoping for a return of 13.46% in 4 weeks. Well, shares of the BOIL, B-O-I-L ETF, fell $2.69, ending the week at $15.66 per share. The call option that we sold lost $1.26, leaving us with a net loss of $1.43 if we were to close the trade out immediately. Now, this is not good, and it's a reminder that the danger in the covered call is the fact that the stock price can fall enough to create a loss. However, I've also seen multiple times when an initial loss, like this one, was recovered over time by continuing to sell call options against the stock that you own. So that's just my way of saying all is not lost. First, you can consider rolling the strike of the call option down to the 16 strike. You would do this by first buying back the 19 strike and then selling the July 16 call at $1.15. That would lower your immediate loss on the trade down to 28 cents, and you'd have the possibility of picking up 34 cents if the stock price closes above $16 per share in the next 3 weeks. Now, you might even consider rolling the strike down to the $17 strike. That would still leave you with a 43 cents loss on the books this week, but you could make an additional $1.34 on the stock move if the stock closes above $17 per share at expiration. I like that one even more. We at least would still have a decent shot at making a nice profit on the trade. Now, the good thing would be if this stock actually expires out of the money and we're able to keep the stock and still sell another option against it next month. That's a double win in my book. Just because you're going to be able to keep selling options, collecting that expensive option premium, while hopefully the stock price doesn't move too much lower. So either way, it's a win. Make sure you do the math before you make any of these adjustments, just to make sure that you understand what's totally going on. And if you need some help, send me an email and I'll try and help explain it to you. All right, next up, we have the credit spread on Carnival Cruise Lines, symbol C as in Charlie, C as in Charlie, L as in Lima. At the time, the stock was trading for $16.06 per share. I looked at selling the July 16-15 put spread at 37 cents, which could give us a maximum possible loss of 63 cents per spread. Well, shares of Carnival Cruise Line jumped $2.65 higher, ending the week at $18.71 per share. The out-of-the-money put spread that we sold is now even more out of the money. Now, typically, I would say this spread is working out, no adjustments are needed. However, you can buy this spread back for 3 cents, allowing you to lock in an immediate profit of 34 cents, while also removing that 63 cents of possible loss if the stock were to fall again. Now, some people might hold the spread another 3 weeks just to lock in that additional 3 cents of profit. For me, I'd rather close the trade and see the money added to my account balance. So this was a nice, quick trade. No adjustments are needed, but I would seriously look to close the trade out and lock in that profit. So nice trade on this one. And then our final trade from last week is going to be the debit spread on the VanEck Vectors Gold Miners ETF. Symbol G as in golf, D as in Delta, X as in X-ray. At the time, the stock was trading for $34.01 per share. I looked at buying the July 33-34 call spread for 61 cents. That could give us a maximum gain of 39 cents, or that's a 63.93% return in 4 weeks. Shares of GDX lost 6 cents, ending the week at $33.95 per share. The in-the-money call spread that we bought has essentially held its value. This spread is still 95 cents in the money, and the stock is still 34 cents above the break-even price. So even though the stock finished the week a little bit lower, this trade is still working out. At this point, no adjustments are needed, but you definitely should have a game plan for protecting this trade over the next 3 weeks, just in case the stock moves against you. So that's it for the trade review for last week's trades. Let's get into the new trades for this week's show. All trades this week will use the July 19th expiration for options expiring in the month of July. So we'll start off with our covered call on Beyond Meat, symbol B as in Bravo, Y as in Yankee, N as in November, D as in Delta. The stock ended the week at $6.71 per share. I'm looking at buying stock and selling the July 7 call at 41 cents, hoping for a return of 10.43% in 3 weeks. You enter this trade by buying stock for $6.71 per share and selling the July 7 call at 41 cents. This trade makes the most money if stock prices finish above $7 per share, and the break-even price on this trade is $6.30 per share. In real terms, that stock purchase will require $671, and you'll collect $41 for selling the option. Next up, we have a credit spread on AT&T Inc., symbol T as in Tango. The stock ended the week at $19.13 per share. I'm looking at selling the July 19 18.5 put spread at 18 cents, which could give us a maximum possible loss of 32 cents per spread. You enter this trade by selling the July 19 put at 34 cents and concurrently buying the July 18.5 put for 16 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $19 per share. The break-even price is $18.82 per share, and in real terms, you'll receive $18 per spread that you sell and have $32 at risk. Our final trade on the show is a debit spread on Snap Inc., symbol S as in Sierra, N as in November, A as in Alpha, P as in Papa. The stock ended the week at $16.61 per share. I'm looking at buying the July 16.5 call spread for 32 cents, which could give us a maximum gain of 18 cents, or that's a 56.25% return in 3 weeks. You enter this trade by buying the July 16 call for $1.07 and concurrently selling the July 16 half call at 75 cents. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $16.50 per share. The break-even price is $16.32 per share, and in real terms, you'll pay $32 to enter the spread, and your maximum gain is $18 per spread. So that's it for this week's show. Thank you guys so much for listening. I do have a couple of emails to return, so if you haven't heard from me and you emailed me, don't worry, I'm on it. I'm going to get back to you here shortly, or just shoot me another email. It's better to email me at my email address, but if you forget that, you're welcome to go to the contact page of the website and reach me that way. I do get those emails as well. So you guys are fantastic. I've got the best group of listeners out there. So please share the show. Thank you for listening. Thank you for all the wonderful reviews that are out there as well. You guys are amazing. And hey, as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.